Let's just head straight to debt. How does debt play a role in this, and how do you think about it? Like, as I said, it's how you think about it. Is my aim that the end game I should have no debt? Is it wrong or bad or not the greatest idea to have 50% debt when I'm 80? Is that even an issue?
You want the answer?
Definitely.
Depends. So here's the thing, right? It depends. So here's the thing. Here's the way to, let's talk about how to think about debt, because every single person is going to be different. It's all going to depend on your risk profile. I am absolutely not going to sit here and say, well, everyone should have 50%, loan to value ratio, because, hey, now I don't know. Like, it depends. If you want a higher...
I want to caveat this, though. I had a conversation with a broker who I will not name. It's not the broker I use. If you are listening to me, you were good about this. But he said to me, like, legitimately, you would not be wanting to head into your... He goes, you shouldn't be carrying any debt after 65. He said, your whole plan should be working. And I'm like, I don't think that's right.
That's
maybe.
No. You cannot live in those levels of absolutes. What happens if someone's listening to this and they're 60 and haven't built a wealth plan? Like, they're going to guess what? Go carry some debt. Like, it's not that. Debt is not bad. There's nothing wrong with debt. It's all about managing risk. So, if you want a higher return on investment, if you're optimizing for return on investment, more leverage is better. Like, let's take this to an extreme. If you could have a portfolio, let's just simplify it, at one house. If you bought one house at 100% LVR, right, or let's just say 99% LVR, okay, and it's a $500,000 house, and you bought it at 99% LVR, so you've only got 1% of debt of equity in the property, and all of the rest of it is debt. And then, so you've got, let's say, $5,000 in the deal, and then it goes up by 10%. All right, so it's made $50,000 of operating profit. Now, just like all profits in any business, to get that profit out, you're going to need to pay tax on it, okay? And this scenario is called capital gains tax. But it doesn't matter, even if you sell shares, you're going to pay capital gains tax. Everyone goes, oh, so what about the selling costs? You're going to realize selling costs or liquidation costs, regardless of how you access your capital. So I think it's just a completely moot point. Anyway, moving on from that little rant. So, if you've made $50,000 of profit out of 10% growth and you've only put $5,000 in it, I haven't got the maths on that, but what's that? What's that in terms of return on investment? It's like a 1,000%, 10x? Well, it's 10x, right? So it's 1,000%. That is a 1,000% return on investment. So you say to someone like, do you want 1,000% return on investment? Awesome. Go and find someone who'll give you a 100% LVR loan. They exist, right?
They exist.
They
Scary,
exist.
But they do.
Yeah, go and get a 100% LVR loan and go buy a house, right? And just like if it goes up, dude, crushing it on an ROI basis, right? That's awesome. But it's pretty high risk, right? Let's be honest, right? If you are leveraged that high, it is higher risk. Now, some people have got different risk tolerances, and it's going to depend on where you are in your journey as well. So, for example, if let's just take an example that if you bought a 95%, I actually did this calculation the other day. I'm trying to remember the price point that I did it at. I think I did a 95% LVR on a $300,000 property on an average growth rate of 5% a year, and it was on interest only at 6% yield, right? And so I did all this. That was the basis of the test. I just wanted to kind of have a calculation on the ROI. And I said if it grew at just 5% a year, so no moonshot growth, no double-digit years, nothing like that, just 5% a year, pretty average. Now, and then I capitalized the growth and the cash flow together. And then I said, what if we sold it after 5 years? Because you get an interest-only period for 5 years, right? So I said, what if we just got one $300,000 property at 95% LVR? It grew at 5% a year. It was 6% yield, and it was on interest-only. And at 4 years and 11 months, we sold it. So then I factored in capital gains tax, I factored in selling costs, and then I said, okay, what would be the net return versus the capital injected? Now, I can't remember the exact numbers in front of me, but it was something like over the 5-year period would be a 288% return on investment, which is an annual rate of return of 60% roughly, nearly.
We'll have to get someone to fact check our maths in this conversation. If anyone's listening, of course, quotable numbers here.
Yeah, totally. But like, I'll actually maybe record something and stick it in the show notes on this because it's really interesting. On a return on investment basis, it's quite good. But what you asked about was debt and what's the end game. Is that the way you should think about optimizing your portfolio forever? Well, no, probably not, because that's not going to be optimizing for cash flow over the long term. So as you start to move into different phases in your portfolio, you're going to want to be considering what is the best based on your life plan and life situation.
Okay, so to reiterate that around, okay, because this is the part where it's like, I want to make sure we answer this, because this has been literally a question I've been thinking. I'm 32 today. I've got a good working career ahead of me. I enjoy my business and I want to keep doing it.
Yeah.
My earning potential across this time is solid. Well, I think it is.
Yeah.
Probably people out there smashing it, but when I look at that, I go, okay, well, if I'm going to take on 80% LVRs or anything right now, I'm not as concerned because I can look down the road and say, well, there's years of good earning ahead of me potentially. And I'm comfortable with that because I can pay these things off or raise capital or do what I has. How does that change for the person that's, let's say, 60 then? Because they don't have that, or 62, we'll use 30-year gap. Do you change the way you think about debt and lending?
I don't want to sound too ambiguous, but it entirely depends, because what you actually need to consider is not the debt. Don't think about the debt. The debt is just a tool. Like, the banks are saying, like, we're happy to secure against an asset at a certain basis. Now, 80% LVR, you got to think about that. How bad would that property need to go for it to go completely bad, right? What would need to happen if you had an 80% LVR? So the bank owns 80%, you own 20%. For that property to go bad, as in like for that to go into negative equity where it's potential to get foreclosed on and it's no good, right? Well, for it to go bad, it'd need to fall in value by 20%, right? Now that has happened in Australia. You can look at places like Perth and find examples of markets that have done that. But that's where you need to start thinking about your risk and exposure. Like, what are the drivers in the marketplace and all of that kind of stuff. You've got to think about your exposure risk. Would I, if I was 65 years old, want to have a $10 million property portfolio leveraged at 80%? Probably not. But I'd also say that's a little bit down to personal preference as well, right? Because here's the thing that you need to really be thinking about. You need to be thinking not so much about like, what's my debt position? It's what's my risk exposure? What is my cash flow? How many moving parts do I want in my business, i.e. my property portfolio, all of that kind of stuff. Because there's a couple of different ways to think about it, right? If you owned less assets and had zero debt, they would be way higher cash flow. So what I spoke about a moment ago was optimizing for return on investment. Typically, when you optimize for return on investment, you're not optimizing for cash flow. That is not a good way to go for cash flow, because the more debt you have, the more expenses you have. The debt is
you've got to pay more interest.
Totally. The debt is the most expensive part of the operating costs of your real estate empire, right? Your real estate business. So then you got to think about, well, what am I optimizing for? And we've used that term a lot on these episodes. I think it's so critical to think about that in so many different ways. Because if you're optimizing for cash flow and you have more capital, then it kind of like it changes the game. Because you could, for example, let's say you're a cash buyer and say you've got $1 million in cash and you go and buy a $1 million property that is yielding at 4%. Now, I'm not going to do the maths on that because I don't know it, right? But that's going to produce a significant amount of cash flow. Why? Because you've got no debt.
Yeah, well, $1 million property, 4% would be $40,000 a year.
Yeah, minus things like property management rates and everything like that. So there'd be a little bit of a net difference.
Call it 30. We'll go 30.
Yeah. Then. Okay, cool. Awesome. Right. And so if you had the ability to do that, you would have $30,000 cash flow. Now, if you said to someone, do you want to buy $1 million property that has $30,000 cash flow? Most people are like, oh my God, it sounds great. But what you're really talking about is what's the debt equation in that property. And this is how I think that we need to change the way we think about debt and what the end game is. Because a lot of people will say, here's the strategy, right? You buy 2 properties every year, and then I've seen this played out before. It was like buy 2 properties every year for 10 years, or maybe it's 1 property every year for 10 years, and then get to year 10 and then sell half and pay down the other 5, and then you have 5 that give you the cash flow you need for life, right?
I'm so happy you said that. That's literally the next question I had on my notes. So
really?
was talking, because this is the next period. So we're talking about, okay, as you get older, the amount of debt associated to return versus cash flow and
Yeah.
risk, which I think is the big one there. But then the next one I go to is even if you're that same person, and we'll use an example, pretend you've got 10 $1 million properties and you've bought one a year for 10 years. Is the aim then to give it time to pay itself down from rents?